In this video, I'm going to show you exactly how I would restart my day trading career, knowing what I know now, if I could do it over. Okay, I've been day trading for over 8 years, and before developing my process to be able to now have 3, 5, sometimes $10,000 single profit days, okay, I realistically wasted years of my 20s and tens of thousands of dollars trying to learn this, that had I have known what I'm going to share with you in this video, I wouldn't have had to. So I'm going to start with trading foundations so that you can understand trading in its simplest form. Then I'm going to show you all the tools that you need to set up to be able to do this. Then I'll dive into trading psychology, which you'll come to learn is probably the most important part, followed by trading math, a crash course of the most important things that I use when I'm doing technical analysis, then how I actually build and test strategies for myself. Okay, and then at the end, I'm going to take everything that I've showed you and apply it into a real-time trade scenario so you can see how to take all this information and apply it in real time. So if you make it to the end of this video, you're going to have a complete consolidated path to start your day trading career. Okay, so starting off this process, I think it's extremely important to understand trading in its simplest form. Okay, there's a lot of different indicators and a lot of complexities that go into day trading, but if you start at this point, it's going to make everything else a lot easier, I promise. So what we're looking at here is a simple chart of the S&P 500. This is basically the top 500 tech stocks in the US stock market. So you'll see the market is moving up and moving down at different periods. This is because along this process, we have buyers and we have sellers in the market. Okay, and this price movement is simply a result of supply and demand in the market, and what you're seeing is a visual representation of that in chart form. Okay, so when there's more demand for something, price will continue moving up until a period where the supply starts to outbeat the demand, and that's where price will start to make its way down until the demand starts to outweigh the supply. Okay, and then it will reverse back in the opposite direction. Price moves back and forth, always trying to find this equilibrium between the buyers and sellers and the supply and demand imbalances that come from that. So the whole goal of trading is to find something where you believe the value is to increase, say for example from 200 to 205. Okay, so however many units you buy at this value, when you go to later sell it at an increased value, you get to keep the increased amount times however many units you had, and that's going to be your profit. So in this case, you'd have 100 units times $5, okay, which would give you a profit of $500. For example, the stock market goes up by approximately 10% per year. So say we're buying in with $100. Even if we have a good year in the stock market, after all said and done, we're still only realistically making a profit for that year of $9. So unless you're starting with a ton of money, this isn't going to be a feasible way for you to actually generate income. So right now we're looking at this from a 1 year perspective. Okay, but if I zoom in on this circle, we just look at things based off of the one past day of movement, we can see the market actually took a pretty significant move to the upside. So if we were to take our same exact scenario and say we had reason to believe with a strategy that we wanted to use that same $100 and buy in right at this area, and we knew if it came to this area, we wanted to get out of our position. Now with that same $100 worth of risk, if price moves to here before coming to here, we now have an opportunity to make 5.3 what we're risking, which would be $530 worth of profit. Okay, but as we get more zoomed in, not only do we have to figure out actually where these ideal places to buy and sell are, we really have to focus on risk management and understanding the trading math to do this properly. Okay, but with this proper framework established, we can actually pick these small deliberate areas, allow these daily moves to sort of take place, okay, and be able to really benefit off of large moves in the market. Okay, this trade example, I'm risking $500. I made almost $5,000 in one single trade. Okay, and that's not to brag, that's just to showcase if you lock in and learn something like this, the opportunities that come with it. Okay, and obviously we don't have a crystal ball, but instead of just guessing random areas to get in with random amounts, now we actually have a framework to be able to treat it like a business and ultimately make profit over time. All right, so let's get into the tools that you're going to need to actually start doing this process. Okay, so the first thing that we're going to need is TradingView. This is where we're doing all of our analysis and really the foundation of our trading. So once you go to TradingView, you create an account, you're going to click on Super Charts. That's going to bring you to the charts like we were just on. So we're going to dive into that further in a second. The next thing that you're going to need is a place to actually execute these trades. All right, so I'm trading crypto, so we need some sort of exchange. Okay, I like to use Bybit or Blowfin. Okay, and some of the students that are trading futures on the stock market side can use a prop firm like TopStep or really any other prop firm. All right, and the last core thing that you're really going to need is a good trade journal. Okay, I actually created one and we'll share it with you guys, but we're going to talk about that a little bit later. Once we're in TradingView, this is what our charts are going to look like. And I want to show you sort of the way I look at it and where my foundation of trading is as a whole. Okay, so you'll notice from before, our chart was just a simple line. All right, so you can see over here as well, we can look at this market movement in just a line form, but for day trading, in order to get a little bit more information, we actually use something called candles, which we can click right here and switch our view to candles. So the way that these candles work, it basically shows us all of the price movement over any given period of time. Say for example, this is a 1 minute candle. It's going to show us where the price opened, closed. Okay, the close being above the open indicates a green candle, in which case there was an increase over this time increment. And then this is going to show us our high and low. And the same is true with the red candle. It opened here, closed here, which indicates a net negative change over the time. And then once again, the high and low periods are identified by these wicks. So when we look at this on TradingView, now not only are we getting the trend information where we see where the market is having its supply and demand imbalances. But now we're able to get a little bit more granular information as to where the price moved back and forth over any given period of time. For example, I'm trading cryptocurrency, but this applies basically to everything. And what we're looking at right now is the price movement over time of individual pairs. And what I mean by pairs, you'll see this is Ethereum against the US dollar. So if Ethereum increases in value against the US dollar, the chart is going to go up. And then if it decreases in proportion to the US dollar, then the price is going to move down. So we can look at different pairs when we're trading to try to find which are offering the best patterns and movement that fits into the way we want to trade. Okay, and with respect to candles, we can also look at this data on what are called different time frames. So right here, you can see this is a 1 hour frequency, which means that each one of these candles is showing me 1 hour worth of price movement in each individual candle. So you'll see this red box here is the same exact size on both charts, but over here, each candle is representing 1 minute worth of price data. So we have a bunch of small candles in here, only 3 candles over here, even though we're looking at the same data. And the data that we're looking at is basically the price movement of individual pairs. So TradingView is really going to allow us to start doing analysis to find areas in the chart where we can find these small opportunities and start building out trade ideas to then go be able to execute on the trend. So for example, I can click on my drawings up here on TradingView, okay, and say I'm trying to do trend analysis and I'm drawing a line along the lowest points of this trend. Okay, doing things like this, you can see if price makes contact here, 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 comes back down to that area. Now we start to have reason to believe generally where there's areas where price could come down to, respond, and then turn back around. And additionally, because of that supply and demand concept that we were just talking about before, when there's too much demand and not enough supply, and that trend finally breaks, these are oftentimes key areas as well where price will try to come up into before also making a big shift in the opposite direction, once again opening up some of these trade opportunities for us. Okay, but before we get way too far into technical analysis, I want to go over the most important element of trading, which is trading psychology. Okay, and as weird as it sounds, you actually need to basically rewire your brain in order to be a successful trader. All right, things that intuitively make sense that make you otherwise successful in real life are going to do the exact opposite in trading and actually make you a lot worse at trading. It's one of those weird things that you need to reprogram your brain. Okay, and I'm going to explain this to you from a perspective of someone who's been doing this for 8 years to hopefully give you that aha moment and shave off a ton of time with your trading. Okay, this is the most important thing. So innately as humans, we're programmed since childhood that losing is bad, okay, that being wrong is bad, and making money is good. All right, all things that make sense in regular life. But when we apply this to trading, it's completely different, and I'm going to explain why. So anytime we're entering a position, one of two things is going to happen. So if we're entering here, price is either going to come up to this level for a full profit or down to this level for a full loss of whatever dollar amount we're risking. Okay, if we look at this in really simple terms, just in units of risk or units of R, if we're wrong, we lose -1 unit of R, and if we're right, we make 3 positive units of risk. Okay, and the math that I'm explaining to you here is the only way that you'll actually be able to execute on this mental rewiring that I'm explaining to you. In order to have our 1 unit of risk, say whatever we're buying is priced at 200. All right, our risk is at 190, and where we expect the price to go is at 230. Okay, what we want to do is be able to set this unit of R as a constant. First, I'm going to show you mathematically how this works. I also have a way faster, more simple way that I do this in real time that I'm going to show you in just a second. All right, this is something that most people do not follow. Say we want to risk $100 on this position. In order to guarantee that if price comes down to here, that we're risking exactly $100, here's what we have to do. We take our entry price, 200, minus our stop loss value, which is 190. That gives us 10. And then we take the dollar amount we want to risk. So say 100, divide that by what we got before. And that's going to give us the exact amount of units that we need to buy right here in order to risk exactly $100 on this position. Okay, and every time we're entering the market in one of these positions, considering one of two things is going to happen, okay, there is a % probability of whether this level will be triggered before this level. And the only way that we'll have the opportunity to be able to allow the trade to potentially make us 3x what we're risking is if we're willing to expose ourselves to potentially losing money. Okay, so let's take this situation for example. Say we take 10 total trades, and out of those 10 total trades, we're only right 30% of the time. Okay, intuitively you're thinking, wow, 70% of the time you're wrong and losing money, like you must suck at trading, right? But if we look at this in a situation, if we keep our risk uniform and contained, we have 1, 2, 3, 4, 5, 6, 7 losses over here, which would equate to -7R with an average of -1R every time we lose and a loss rate of 70%. But let's say on the winning side, we keep our winnings open-ended, allow the trends to continue when they're working in our favor. And even though we have only 3 wins, say we have 5.2, 2.5, 3.1 positive risk units, which gives us a sum of 10.8, an average of 3.6. Even though we only have a 30% win rate. Okay, even so, in this situation, being wrong 70% of the time, we're making a positive 3.8 units of R, which if we're risking $100 is going to leave us with a profit of $380 over those 10 trades, being wrong once again 70% of the time. Okay, and realistically as a trader, this is the only math, truthfully, if you boil it down to its simplest form, that really matters. Okay, so we're right 30% of the time, and we're making on average 3.7 units of R, which puts us somewhere between 3 to 1 and 4 to 1, which in the square is going to put us in a profitable position. Okay, but like I said, in order to even put ourselves in a position where that's possible, we absolutely cannot look at losing as a bad thing, because it's opportunity cost to allow what's called an edge, which is what allows our edge to play out over time. Okay, if we're worried about being wrong, right, we're never going to allow ourselves to take trades, and we're going to take it as an ego hit and start acting emotionally towards this, where realistically, if you're looking at this properly in form of a data set, the outcome of each individual trade over time actually doesn't matter at all. And additionally, not associating making money with a good or bad trade, because what a lot of people will do is they'll take a really risky trade where it's not proper, they're not following their strategy, and they'll get lucky and make a lot of money and think that was a great trade because I made a lot of money. Okay, but they realistically did something really stupid. Conversely, you could set up a perfect trade where you're managing your risk, you're following all your rules, and you take a loss which is calculated into this entire process, okay, and look at it as a bad trade because you lost money. If you approach trading with these mindsets, you're going to be looking at it completely wrong. You're going to be doing things emotionally, and you're always going to be chasing the next thing to try to constantly win, when realistically it comes down to finding a simple strategy that works, following your rules very strictly, and allowing it to play out naturally over time. Now that we understand the trading math and the structure around this, let's take a deeper dive into the technical analysis. We're going to start to get a little bit more advanced as far as the simple things that I like to use when I'm finding my overall trading opportunities. Okay, because the movement that we're seeing on this chart is a lot less random than you think if you know how to look at it the right way. The first thing that I'm always doing when I'm doing my analysis is I want to find the trend tops and bottoms of these ranges in the market where price is moving up and moving down, moving up, moving down. So let's take these 3 points for example, 1, 2, and then we have 3 over here. What you want to do is sort of find where these levels are creating an invisible level where the price cannot break through it. And what you're realistically looking at is that supply and demand imbalance hitting a specific level over and over again. Price is here, there's more demand than supply, price comes up. Up here, there's more supply than demand, demand comes down. Here, demand outweighs the supply, goes back up. So if we start to draw our lines, we can see this time price came down, tested this area, but this time had a big push and break underneath that trend. Like I was showing you before, not only can these trends allow us to see areas generally where we can expect to see price bounce off of, and I'm going to show you more things that we can use to sort of accentuate our conviction that we will get these flip points, but this is the probably one biggest thing that I use to generally find smart setups, is where you can see price breaks through it, comes perfectly back to test the opposite side of that trend, okay, before making a massive directional change for the day. Okay, we can look at tons of examples of this playing out. So let's take this area of our chart here, right? Looks like a random area on the chart, but if we go back to all of this price action being the movement in the price, if I start drawing my line again from this high to that high to this high, all right, and we go ahead and extend this to the right, now you can see this was the exact low point before a massive move in the opposite direction. Once again, as soon as that trend level was broken and it came down to retest it, look at what happened, right? So if we set our risk to here, now we could have effectively risked $100 to make $635. All right, so just to really drive home how well this works, okay, I'm going to show you how I tie this into a strategy a little bit later. If we take this new trend level, we go along this low, this low, wait for a break up, we tested the underside of this trend before once again a massive directional change in the market. Okay, this example would have been 9. Now, of course, as professional traders, we're doing data testing on this. We have specific strategies that have to align with these ideas. This is kind of the starts of the foundation of how we build up our ideas and how we're able to pick and find these smaller opportunities. Okay, the next thing that I use almost all the time when I'm doing technical analysis is something called Fibonacci. You can find this right here on TradingView. So this is how Fibonacci works. Let's say we have a trend that's moving in this direction. I can go ahead and click at the base of this trend to the high, and you're going to see I have some numbers over here ranging from 78.6, 61.8, 50, 0.382, and 0.236. What a Fibonacci retracement is showing us is basically retracement ratios is based off a sequence that occurs in nature. Okay, in particular, this 61.8 ratio is what we see in seashells, trees, facial symmetry. It's basically the framework of the entire code of the universe. And for whatever reason, when price makes its way down into these levels, the 50 level is oftentimes the level things will retrace into before making a continuation, as well as the 61.8 level, which is considered the golden ratio for trend retracements and then continuations. This green level is really what we want to pay attention to. When we're looking at trends, there's actually a deeper way that we can evaluate where we are in a trend and whether it's likely to change direction. Okay, this is something that I'm using all the time in my analysis. So to understand this, we have to understand that trends develop in 5 wave patterns. This also ties back towards human psychology. We're just looking at a really zoomed version of it. So 1, 2, 3, 4, 5, which are typically followed by what's called an A, B, C pattern. And this is referred to as Elliott waves. So to add to the next layer of how I'm looking at trends, I'm also taking this into consideration. Now, I have a whole video where I go into way more detail about how this works. I'm going to link that at the end of this video so you can dive more into it. But basically, I can judge where we potentially are in a trend based off of this. Okay, and what's really cool about this is I can actually use a tool called a Fibonacci projection. This is one of my favorite go-to tools. You can find it right here on TradingView. So we can use it for dip buys in overall trend levels. We can also use this same exact golden ratio to take this initial push in our wave and actually figure out where the exact top of the trend is likely to be. So we can click on this trend-based fib extension tool. Now I'm clicking at the first part of the trend up to the high, back down to this one level, which is creating that what's called factor of 1. Okay, obviously this was a drawing, but say for example, we had 1, 2, 3, 4, 5 waves coming into a 261.8 projection, and we start to notice a response off of that level. That very well could indicate that this whole entire trend is about to reverse. So we can really use all this trend analysis to figure out where we are in a trend movement. All right, so let's take a look at this as an example on the chart. If this is our new trend movement up, we can pretty clearly see that this was a low, push up, pull down, push up, pull down, and then a big push up. So if I take my trend-based fib extension, once again, I click at the low of this trend to the high point here, back down to the low. I want to see the high of 3 oftentimes hit off of the 161.8 and the high of 5 start to respond well off of the 261.8. All right, you'll see that's exactly where the trend started to consolidate, push back down. Now we can start to see this structure. So if we take our Fibonacci retracement this time, start from here down to here, you can see price came up almost perfectly to that 61.8 level before making its way down. So my next favorite thing to use when I'm doing technical analysis is something called a fair value gap, which you can see on my chart here by these red squares. So basically what a fair value gap is doing is showing us a sequence of 3 candles. So we have 1, 2, 3 candles. If generally the price action is moving to the downside, this is going to be red or a bearish fair value gap, and then vice versa. If it is to be moving up over time, it's going to be green. All right, and what we're really looking for is in this 3 candles, for the first candle's wick to not overlap the third candle's wick, and the space between that is called a fair value gap. Now you'll notice if I scroll out a bit, this is often an area when trends are moving, the price will come back into, have a response off of, and then continue to move down. You can see that over and over. So you'll see price comes back up into the midpoint of this, back down, comes back up into the midpoint of this, comes back down. So you really don't want to use these just out of nowhere, but in conjunction with your other technical analysis are extremely powerful tools. All right, and you're going to see that in examples a little bit later in this video. Okay, so remember we drew our trend levels from here to here, okay, and then price broke underneath it, came back up to test the opposite side of this trend before making a move downside, coming back into this fair value gap, which once again we can use as a layer of confidence to get into the chart in these key different areas. Okay, if we look back at our other trend example, fair value gap, price dips into it, continues moving higher. All right, once we get up to our 5 wave at 261.8, we get our first push down, price comes back into the 61.8, into the fair value gap before having a massive roll off in the trend. And you can see price came back to test it here along the way. You can see in real life trading examples, here's my fair value gap, here's where my trend level was just broken. I went ahead and took a position into this area, and you can see price responds exactly off of that key level. Okay, puts me up around 3,000, and I can successfully play into moves in the market like this using those fair value gaps. So now we need to take everything that we've learned so far and actually build this into a trading business plan. So I'm going to explain to you how I build trading strategies and how to test strategies out to actually be able to build a profit machine. So I've really boiled this whole process down into this process right here. So first step is really finding a trading strategy concept. And what that's going to require us to do is take observation on our chart. Okay, so say for example, we're looking at our chart and we're noticing every time we get a red highlight strip here, this is oftentimes where the market will have a flip in direction. So we're going to decide we're going to try buying at these red areas and then selling when we see a green area. Now, trading is not this simple, but I want to show you for the sake of example, how we're going to make a trading strategy. Okay, so this would be our observation. So once we have our observation down, the next thing that we're going to do is something called defining rules. So you're basically going to look at what you think you need to do and set up rules to then be able to evaluate the outcome of those rules. Okay, and what we're really looking for, going back to those two key metrics that we talked about with our trading math, which is really going to be our winning percentage and the average size of our wins and losses, which is playing back into this chart here. So once I have my observation and I want to test this sort of idea, here's what I'll do. I'm going to go ahead and click on this replay feature here on my chart. I'll bring the chart back to a specific said date. We have a red highlight, so then I'll go in. Okay, say I'm buying here and put my stop underneath that level. Okay, then I'm going to go ahead and play this chart forward just by hitting shift, and I'm going to wait for a sell signal. All right, so still no sell signal. All right, so here we get our first highlight strip, which is going to give us 4.84, and then all I'm doing realistically at this phase is going in and putting plus 4.84. Say we're going to flip our position now, try to play it to the downside. Okay, so that would be -1. Okay, we get a highlight, we go down short again. So that would be -R again. Okay, say we're short again. Okay, this time we do get a red highlight, plus 5.26. So you can basically at first run through tests of this and see over X amount of trades, I have plus 4.84, -1, -1, plus 5.26. Okay, which gives you a positive 8.1, which means you can now go to the next layer of testing. All right, so now that we have our general idea that we know works, this is the complete iteration that I'm following to make sure that there's full proof of concept that this strategy works. Trading is one of the only businesses where you can actually completely dry run the entire process, know exactly how it's going to work before you actually put money into the entire process. So we did our on-chart observation, we did a little bit of bar replay, but now is where we really want to start looking at the data so we can push into testing it out on paper, actually executing on a demo account, and then how to actually translate that over and apply it to a real account. So this is where we'll pull up our trade journal here. If you want access to this, you can go in the description, follow me on Instagram and DM me the word tools, and I'll basically send you over a resource that has everything that I use in my trading. Okay, but this is really where we want to start actually acting as if we're taking these positions in real time. Say it's Monday, we're trading Solana. You can pick your strategy. Say example, we're on a 3-minute time frame. In this case, we're taking a long position. We can put in our risk factors that we make on the trades, and then we would play it out. You're basically just going to be tracking whether this is a win or a loss and how many risk factors you made on each trade. Now, let's say you've gone through and you've logged all of your trades, whether they're wins or losses, as well as the risk factors on the trade. Okay, now you can go in here, just check off your wins. You can click on here, go to your average. That's now going to give you your average risk reward on your winners. You'll also have your win percentage right here at 50. Okay, so now we know we have a 5.05 average winning risk reward and a 50% win rate. Okay, which you can see right here puts us well into that profitability zone. So we have our theory that works on chart. We've bar replayed it and we have all of our data. So the next part of this process is realistically to test this out with a simulated account. This is going to allow you to get the reps in using the actual software that you're going to be trading. What we're going to do is pull up our trading view, and then we're going to pull up an exchange to actually take some of these trades. Now let's say we were taking the same exact situation. We have our entry rules here. So now we actually have to input the order. So this is how we can start to build our position. And like I said earlier in the video, I'm going to show you a really easy way to be able to calculate your positions. If you click on this button here on TradingView and type in a NevaTrade position calculator, or if you can't find it, just follow me on Instagram, DM me tools, and I'll also include it in there, right? All you have to do is click on this tool. All right, now you'll notice it's prompting you right on screen to click on your entry. So we're going to click at our entry, we're going to click at our take profit level, and then we're going to click at our stop loss level. That's going to populate a box where you can put the dollar amount that you want to risk. So I can go ahead and confirm that, hit apply. Now it's going to populate data right on the screen of exactly the amount of units that I need to enter right at this price to risk exactly what I want to risk, which is $100 on this trade, and what my expected amount of profit would be if I'm right about my idea. So over on my exchange, you can see I have Solana pulled up. So if I wanted to take this trade, whether it's on demo or live, the process would be roughly the same. You know your exact amount and click on this box here, type in my take profit level as well as my stop loss level. And you can see on the exchange side, I'm risking exactly $100 for $500 worth of potential profit. Okay, but you also notice the cost of this position is $14.5 thousand. So unless you have $14.5 thousand sitting in a cash account, even though we're only risking $100 on the trade, because we have to buy 74 Solana at this price, that's how much capital is required. And this is why we can use leverage. Okay, so if I click on this right here and see if I switch to 10x leverage, I can go ahead and click confirm. Now you'll see we're still risking the exact same amount on the trade, but now the total cost of this trade is now only $1,400. And if I increase this, say, to 20x leverage, now the cost of the position is only $722. So now I have my entire position set up. I can go ahead and hit buy long here, and then trade runs to fruition, gets us out for full full profit. Once again, you put it into your trade log, and you can literally do this on a demo account to know exactly how you're going to perform, to then be able to take it to a live account. Okay, and you've effectively built out your entire trading business plan. All right, so taking everything that we've learned today, I'm going to go through a real life example and show you exactly how I set up trades. All right, so right here, I have my low level set up. Price is starting to break out of that trend. All right, we have a fair value gap right in here. So I can set up a position, contain my risk. Then I'll go to my indicator, click on my entry, my take profit, and my stop loss. Okay, right now I'm risking $1,000 per trade. So I go ahead and confirm that. All right, then we get into the trade right here. See, price takes a nice push down. Now I can basically just ride this trend down until we get a reversal. Price comes down to my full take profit. And then I'm basically screenshotting this, inputting into my journal, and the trade's complete. And if we look at the real life recording of me actually taking this trade, you'll see I have my lows established. I know I want to take a short position into here. Okay, I go ahead and get into my position. You can see right away I go up about $450. And basically I'm reducing risk along the way as the trend moves in my favor. You can see I'm up 3,000. I've already locked in 1,400 just by keeping my risk contained, having a strategy that I know works based off of data, and allowing my winners to run. And this trade basically allowed me to lock in almost $5,000, risking $1,000. So I was able to make 5x what I was risking. Okay, and this is exactly what we're focusing on the private side of our team, systematizing the process. And you can see people focus on the units of risks. You can see K Money, who got the education, 19 risk reward. You can see DeCrone's at 15 R, using and learning our full strategy. Amazing milestone achievement. Okay, growing accounts. People taking the education and getting funded like crazy. Tidy getting funded on a 50K account, thanks to the Nevitrade team. Okay, as promised, if you want to learn more, you can watch this video to learn more about the technical analysis components. If you want to check out our private education and team, I'll put the link right here. Okay, if you found this video valuable, hit the like button. If you want to know when I put videos out, make sure you subscribe. If you want the tools, follow me on Instagram and DM me the word tools. But until next time, I'll see you all in the next video.